Friends, thank you for being here today. What if I told you that the second largest economy in North America is vanishing in real time? Not slowing, not adjusting, vanishing. And the only people who refuse to call it what it is are the statisticians paid to count the bodies. On January 30th, 2026, Statistics Canada released data that should have sent shockwaves through every financial desk from Toronto to Wall Street. Real GDP in November, flat, 0% growth. But here's the part nobody expects. The flash estimate for Q4 2025 suggests the Canadian economy contracted by 0.5% annualized. This is not theoretical, it is observable. Canada, a G7 nation with nearly 40 million people, is now actively shrinking. And this is where the simple logic does not apply here. You were told that immigration would save GDP growth, that bringing in hundreds of thousands of new residents would automatically translate to expansion. The arithmetic was supposed to be straightforward. More people equals more consumption equals more output. But the math just hit a brick wall, because here's what actually happened. While the population surged, the productive capacity collapsed. Manufacturing fell 1.3% in November alone. Durable goods production hit levels not seen since 2011, excluding the pandemic. This is a structural fault line, not a temporary blip. Let me be precise. We are witnessing something incomprehensible to most economists who still operate under the illusion that developed economies don't contract outside of recessions, but Canada is proving them wrong. This is a default in all but name. The economy is not growing. It is liquidating, and this part has already begun. Here's the moment the clock actually starts. October 2025, GDP contracts 0.3%. November arrives flat, zero growth. The momentum doesn't just slow, it stops. And then the preliminary December flash estimate shows a meager 0.1% uptick, driven entirely by services, not manufacturing, not exports, not production, services, which means the real economy, the one that builds things and ships them across borders, is in free fall. We don't have months. This is happening in days. Now, let me show you what actually happened. This is not speculation. This is forensic evidence. In November, wholesale trade contracted 2.1%. Motor vehicle and parts output, the backbone of Ontario's industrial heartland, dropped over 11% that same month. Metals and non-metallic goods exports, which Canada relies on for foreign currency, plunged more than 24%. These are not rounding errors. These are cascading failures in the real productive base of the economy. And here's where everything changes, because what comes next is worse. Canada's trade deficit widened sharply in November, not because imports surged, but because exports collapsed. Nearly 90% of Canada's trade is concentrated with a handful of partners, meaning there is no diversification, no backup plan, no escape hatch when one major buyer pulls back. This is where the crack becomes an earthquake. The entire export model, which Canadian policymakers have relied on for decades, is imploding under the weight of external demand shocks and domestic production failures. But that's not the real problem. The real problem is what this means for the scaffolding holding up the entire Canadian financial system. Let's cut through the noise. Canada's household debt to income ratio is among the highest in the developed world. Mortgage debt alone sits at staggering levels because the economy was built on a single assumption. Housing prices always go up, and GDP always grows. But once this shifts, everything above it starts to shake. Here's the part they never put in the official reports. Canada's banking system is deeply exposed to real estate. When GDP contracts, employment softens. When employment softens, mortgage defaults rise. When defaults rise, the banks start tightening credit. And when credit tightens, the liquidity that was propping up asset prices from homes to commercial real estate begins to evaporate. This is the mechanism hiding in plain sight. Now, let me take you back to the genesis of this crisis. This didn't start in November 2025. It started decades ago when Canada made a structural bet: tie the economy to resource exports, real estate speculation, and cross-border trade with one dominant partner. For years, this worked. Commodities boomed, housing prices soared, trade with the United States flowed freely, but the foundation was always fragile. It was scaffolding, not bedrock. And the first tremor came in 2025 when global supply chains started fracturing and external demand began to wane. Here's what I call the big secret of the entire system. The Canadian economy has not been growing organically for years. It has been growing arithmetically. Population increases were counted as GDP growth, even when per capita output was stagnant or declining. Government spending masked private sector weakness. Debt accumulation was rebranded as investment. But the underlying productivity, flat. The industrial base, eroding. The export competitiveness, declining. This is not a conspiracy. It is a stated policy buried in central bank reports and budget forecasts. And this leads us to the system's most crucial secret, which we will explore later. But first, you need to understand the mechanics of what is unfolding right now. Statistics Canada released the flash estimate for Q4 with one critical caveat: it is preliminary. Final numbers could be revised, but here's the detail even analysts tend to miss. Preliminary estimates rarely get revised upward in an environment like this. They get revised down. Why? Because when an economy is contracting, the initial data captures only the most visible declines. The deeper rot, the bankruptcies that haven't been reported, the layoffs that haven't hit the unemployment stats yet, those come later. We haven't even reached the breaking point yet. Let me show you the forensic trail. In November, agriculture, forestry, fishing, and hunting all posted contractions. These are foundational sectors. They don't contract in a healthy economy. Wholesale trade, the arteries that move goods between producers and retailers, fell 2.1%. This isn't a supply glitch. This is demand destruction. Retailers aren't ordering because consumers aren't buying, and consumers aren't buying because incomes are under pressure and confidence is collapsing. And here is where the cascade becomes unstoppable. Manufacturing durable goods in November reached their lowest monthly level since 2011, excluding the pandemic shutdowns. Think about that. 2011, that was over a decade ago. During the aftermath of the global financial crisis, Canada is now producing at crisis levels without an official crisis designation. This part isn't a prediction, it's math. Now, here's where common sense actually becomes your enemy. You might think, well, services are growing. That's good, right? Wrong. Services growth in an economy like Canada's, driven by government spending and domestic consumption, is not productive growth. It's redistributive. When manufacturing collapses and exports crater, service sector expansion becomes a lagging indicator of decline, not a leading indicator of recovery. It means the economy is consuming what it already has, not creating new wealth. The liquidity tide is going out, and we are about to find out who is swimming naked. This is a singular inevitability. The architecture of the Canadian economy, built on cheap credit, inflated assets, and external demand, is crumbling. The bond vigilantes, those investors who punish governments for fiscal recklessness, haven't arrived yet. But they will. Because when GDP contracts and deficits widen, the math becomes inescapable. Canada's debt to GDP ratio is rising, tax revenues are softening, and the only way out, according to conventional policy, is to borrow more and spend more. But that playbook only works if growth returns, and growth is not returning. Let me be clear about what we are witnessing. This is not a recession in the traditional sense. This is a structural unwinding. The Canadian economy was never as robust as the headline numbers suggested. It was a house of cards built on debt, immigration-driven population growth, and a real estate bubble that papered over productivity stagnation. Now the paper is tearing, and what's underneath is not pretty. Here's what's really behind it. The trigger event that everyone is ignoring happened months ago, but the effects are just now materializing in the data. In mid-2025, the United States began signaling a shift in trade policy, tariffs, restrictions, renegotiations. For Canada, which sends nearly 75% of its exports south of the border, this was not just a policy change. It was an existential threat. And the Canadian government's response? Denial, delay, diplomatic platitudes. But the markets don't care about diplomacy. They care about cash flows, and the cash flows are drying up. Let me show you what that looks like on the ground. Motor vehicle production, the industrial backbone of Ontario and parts of Quebec, is now running at the lowest levels since 2011, not because of worker strikes, not because of natural disasters, but because global supply chains are fracturing and demand is evaporating. Semiconductor shortages constrained output, yes, but the deeper issue is that North American auto demand is softening as consumer financing costs rise and household budgets tighten. For the average household, this means layoffs in manufacturing towns, reduced hours, falling incomes. For pensions, this is catastrophic. But this isn't even the part that scares me. The real canary in the coal mine is wholesale trade, down 2.1% in November. Wholesale is the invisible infrastructure of the economy. It's the layer between manufacturers and retailers, the arteries that pump goods through the system. When wholesale contracts, it means one of two things. Either manufacturers aren't producing enough to sell, or retailers aren't ordering because they can't move inventory. In Canada's case, it's both. Production is down, consumption is stalling, and here is where the first domino falls. Exports are collapsing across multiple sectors simultaneously. Metals and nonmetallic goods down over 24% in November, motor vehicles and parts down more than 11%. These aren't minor adjustments, these are structural breaks. And because Canada lacks economic diversification, when two or three major export categories crater, the entire trade balance implodes. The trade deficit widened sharply in November, and that deficit has to be financed somehow, either through foreign capital inflows, which are slowing, or through debt accumulation, which is accelerating. This is where the domino setup becomes visible. Now, let me walk you through the sequence. First, exports collapse. Second, manufacturers cut production. Third, wholesale orders decline. Fourth, layoffs begin. Fifth, consumer spending contracts. Sixth, service sector growth, which was masking the decline, starts to slow. And seventh, tax revenues fall while government deficits widen. Each step is mathematically linked to the next. And once the first domino tips, the rest follow in sequence. And once this shifts, everything above it starts to shake. Here's the forensic evidence that proves the rot is real. Let's talk about specific failures, not just aggregate data. In 2025, there were multiple manufacturing facilities across Ontario and Alberta that announced temporary shutdowns or permanent closures. These weren't headline-grabbing bankruptcies. They were quiet liquidations. A parts supplier here, a machinery manufacturer there, a food processing plant in rural Quebec. Each one shed dozens or hundreds of jobs. Each one removed productive capacity from the economy, and none of them are coming back. This is the detail the official statistics smooth over. When Statistics Canada reports manufacturing down 1.3%, what they mean is that real production facilities operated by real people shut their doors, but the human cost gets abstracted into a percentage. Let me make this concrete. A 1.3% decline in manufacturing output translates to thousands of lost jobs, millions in lost income, and billions in lost economic activity when you factor in multiplier effects. For small businesses that supplied those manufacturers, this means bankruptcy. For workers who depended on those paychecks, this means mortgage defaults. And for the towns built around those industries, this means hollowing out. But the contagion doesn't stop at manufacturing. It spreads. Agriculture contracted, forestry contracted, fishing contracted. These are primary industries, the foundation of the goods producing economy. When the base erodes, everything built on top of it becomes unstable. And here's where the no escape encirclement begins. Because if you're a Canadian trying to protect your wealth right now, where do you turn? Stocks? The Canadian equity market is dominated by financials, energy, and materials. Financials are exposed to real estate and consumer debt. Energy is volatile and tied to global commodity prices. Materials are getting crushed by falling export demand. So equities are not a safe haven. They're a sinking ship. Bonds? Canadian government bonds are still considered relatively safe, but yields are starting to reflect underlying fiscal stress. The government is running deficits during what was supposed to be an expansion. Now that growth is reversing, those deficits will explode. Bond yields will rise as investors demand higher compensation for risk. And when yields rise, bond prices fall. So fixed income is not safe either. Real estate, the market that Canadians have treated as a guaranteed wealth-building machine for 2 decades, is now facing headwinds from every direction. Mortgage rates remain elevated despite central bank rate cuts because credit spreads have widened. Household debt is at record levels. Immigration, which was propping up housing demand, is slowing as the government faces political pressure to reduce inflows. And now, with GDP contracting and employment softening, the ability of households to service existing mortgages is deteriorating. For pensioners who counted on home equity for retirement, this is a nightmare. Cash? Holding Canadian dollars means exposure to currency depreciation. When an economy contracts and trade deficits widen, the currency weakens. Already, the Canadian dollar has been under pressure against the US dollar, and if the Bank of Canada cuts rates further to stimulate growth, that pressure intensifies. So cash is being eroded by inflation on one side and currency weakness on the other. There is no safe corner of the Canadian financial system. Let me be precise. This part is non-negotiable. When all traditional asset classes are impaired simultaneously, you are witnessing a systemic crisis, not a cyclical downturn. And systemic crises don't resolve through normal policy tools. They require structural transformation, debt restructuring, or external rescue, none of which Canadian policymakers are currently discussing. Now, here's the part nobody expects. The services sector, which grew modestly in November and is being touted as the silver lining, is actually the trailing edge of the collapse. Services include retail, hospitality, education, healthcare. Most of these are either government-funded or consumer-dependent. Government-funded services are sustained by deficit spending, which is unsustainable. Consumer-dependent services rely on household income and confidence, both of which are deteriorating. So the services growth we saw in November is not a sign of resilience. It's a lagging indicator. It's the last sector to feel the pain, not the first to recover. Here's what that looks like on the ground. Retail trade showed some growth in November, but early indicators for December suggest retracement. Consumer spending is pulling back. Why? Because households are maxed out on debt, real wages are stagnant, and employment uncertainty is rising. Restaurants and retail stores in major cities are already reporting weaker foot traffic. Holiday sales were soft, and as we move into 2026, the squeeze will intensify. Transportation services, another area of modest growth, are tied to goods movement. But if wholesale is contracting and manufacturing is declining, transportation demand will follow with a lag. The trucks are still rolling in November because they're delivering October's orders, but the orders for December and January are falling. This is the mechanism hiding in plain sight. The data comes in with a delay, so by the time the official numbers confirm the decline, the reality on the ground is already worse. Let me show you what this means systemically. Canada is facing a convergence. One, a structural break in export demand driven by U.S. trade policy and global slowdown. Two, a domestic liquidity crisis as credit tightens and household debt burdens become unsustainable. And three, a sovereign debt spiral as government deficits widen while growth contracts. These three forces are hitting simultaneously, and this is where the cascade becomes unstoppable. This is not theoretical, it's observable. The Bank of Canada acknowledged ongoing uncertainty tied to trade and external pressures in its most recent statements. They expect a modest recovery in 2026 if conditions stabilize. But conditions are not stabilizing, they are deteriorating. The central bank's forecasts are based on assumptions that no longer hold. They assumed U.S. trade policy would remain stable. Wrong. They assumed household debt could be sustained through wage growth. Wrong. They assumed immigration would continue to prop up GDP. Wrong. Every pillar of their forecast has cracked. And here is where the countdown quietly began, because once a central bank loses credibility, once markets stop believing the official projections, the cost of borrowing rises. Interest rates on government debt tick higher. Funding costs for businesses increase. Mortgage rates stay elevated even as the central bank cuts. This is the bond market's revenge. The vigilantes are watching, and they are preparing to strike. But once this shifts, everything above it starts to shake. Because Canada's financial system is built on confidence. Confidence that housing prices won't crash. Confidence that banks won't fail. Confidence that the government can manage the debt. But confidence is a fragile thing. It can evaporate overnight, and when it does, the edifice collapses. Let's cut through the noise and talk about what this really means, not for the economy in abstract terms, not for policymakers in Ottawa, but for you, for your savings, for your family's financial future. Because the danger here is not just mathematical, it's psychological. And the psychological traps are what destroy wealth faster than any market crash. Human beings are hardwired to believe tomorrow will look like yesterday. This is normalcy bias. It's the cognitive glitch that keeps people buying stocks at the top, holding real estate as prices peak, and assuming their jobs are secure right up until the layoff notice arrives. In Canada right now, normalcy bias is running rampant. People see the GDP numbers, shrug, and assume the government will fix it. They see manufacturing decline and think it's temporary. They see export crashes and believe trade will bounce back. But the data forces one conclusion: this is not temporary. This is structural. Here's the part where common sense actually becomes your enemy. You look at your bank statement, your RSP balance, your home equity, and the numbers look fine. Maybe they're even higher than last year, so you think you're okay. But this is the money illusion. You become a millionaire on paper, but poorer at the grocery store. Because while your asset values might be nominally higher, the purchasing power, the real wealth, is eroding. Inflation eats at your cash. Currency depreciation eats at your savings. And when the asset bubble finally pops, the nominal wealth vanishes too. Let me show you what actually happened to people who fell for this illusion in previous crises. In 2008, Canadian households thought they were insulated because the banks didn't collapse like in the US. But wealth still evaporated. Equity portfolios fell 40%. Real estate prices dropped in many markets, and it took years to recover. The difference now? The structural conditions are worse. Household debt is higher, government debt is higher, and the productive base of the economy is weaker. So the next crisis won't have the same recovery trajectory. It will be longer, deeper, more painful. This is where the moment the clock actually starts, because the window for preparation is not measured in years anymore. It's measured in months, maybe weeks. And here is where everything changes. You have a choice to make, not later, now. Do you own assets or claims on assets? Let me explain what that means. When you own a stock, you own a claim on a company's future earnings. When you own a bond, you own a claim on a government's or corporation's promise to pay. When you own a mutual fund or ETF, you own a claim on a basket of other claims. These are all paper. They exist in the financial system. They are denominated in currency, and they depend entirely on the system continuing to function as designed. But what happens when the system breaks? Here's what happens. Claims get restructured, promises get broken, currency gets devalued, and the paper wealth evaporates. This is not a prediction, it's history. It happened in Weimar Germany. It happened in Argentina. It happened in Zimbabwe. It happened in Venezuela. And it's happening right now in countries most people don't pay attention to. The mechanism is always the same. Governments print money to cover deficits. Currency loses value, and anyone holding paper denominated in that currency gets wiped out. Now contrast that with real assets. Physical gold, silver, land, productive equipment. These are not claims on future value. They are value. They exist outside the financial system. They can't be printed. They can't be restructured. They can't be defaulted on. And throughout history, when paper systems collapse, real assets are what preserve wealth. This is not theoretical. It's observable. Let me be precise. Gold is not an investment. It's insurance. It's stepping out of the line of fire. When you hold gold, you are not betting that gold will go up. You are betting that the paper system will fail. And right now in Canada, that is not a speculative bet. It is a mathematical certainty. The architecture is crumbling. The foundation is cracked, and the edifice is going to fall. Here's the part they're not telling you. Central banks around the world have been accumulating gold at the fastest pace in decades. Why? Because they know what's coming. They know the debt levels are unsustainable. They know the currency system is fragile, and they are preparing for the reset. But while central banks buy gold by the ton, they tell citizens to stay invested in stocks and bonds. This is not a conspiracy. It is a stated policy. They need you to hold the bag while they secure the exits. Silver operates on the same principle, but with industrial demand layered on top. As the global economy transitions toward electrification and renewable energy, silver demand is surging, but supply is constrained. So silver has both monetary value and industrial utility. For the average household, this means silver is accessible, practical, and poised to outperform in a crisis scenario. Land, particularly productive agricultural land, is the ultimate real asset. It generates income, it produces food. It can't be inflated away, but it requires scale, capital, and expertise to manage. For most people, land is out of reach, which is why gold and silver become the accessible hedge. You can hold them, store them, transport them, and when the currency collapses, you can exchange them for whatever holds value in the new system. Now, let me show you the binary choice in stark terms. Path 1. You stay in the system. You hold Canadian dollars, equities, bonds, real estate leveraged with debt. You trust that policymakers will engineer a recovery, that the U.S. will soften trade policy, that growth will return. And maybe you're right. Maybe the crisis gets postponed. Maybe the system limps along for another year or two. But the math doesn't support that outcome. And if you're wrong, you lose everything. Path 2, you step out of the line of fire, you convert a portion of your paper wealth into real assets. Gold, silver, maybe some foreign currency diversification. You reduce exposure to Canadian risk. You prepare for a world where the system doesn't recover, where the currency devalues, where claims on assets become worthless. And if you're wrong, you still have wealth. It might underperform in a recovery scenario, but you survive. That's the asymmetry. The downside of being wrong on path 2 is minor. The downside of being wrong on path 1 is catastrophic. This is not a guess. This is math. When GDP contracts, debt to GDP ratios explode. When trade deficits widen, currency pressure intensifies. When manufacturing collapses, employment falls. When employment falls, tax revenues drop. When revenues drop, deficits widen. And when deficits widen in a contracting economy, the bond market revolts. It's a mathematical endgame. The only variable is timing. Here's the moment the clock actually starts. Statistics Canada will release the final Q4 numbers in a few weeks. If the contraction is confirmed, markets will react. Not immediately, not violently, but subtly. Capital will start flowing out of Canadian assets. Foreign investors will reduce exposure. The currency will weaken further, and the feedback loop will accelerate. By the time the mainstream media acknowledges the crisis, it will be too late to act. This is where the window for preparation is closing, because markets move faster than headlines. By the time CBC runs a segment on Canada's recession, by the time economists start debating policy responses, by the time your financial advisor calls to suggest portfolio adjustments, the damage will be done. Prices will have moved, liquidity will have dried up, and your ability to exit positions at reasonable prices will have vanished. Let me be clear about what I'm not saying. I'm not saying sell everything tomorrow and buy gold bars. I'm not saying Canada will collapse into hyperinflation next month. I'm not saying the banking system will fail. What I am saying is this: the trajectory is set. The structural forces are in motion, and the outcome, while uncertain in timing, is inevitable in direction. Canada's economy, as currently structured, cannot sustain itself. The debt is too high. The productivity is too low. The external dependencies are too great. Something has to give. And when something gives in a system this fragile, the break is not gradual. It's sudden. It's nonlinear. One day, everything looks fine. The next day, a bank announces losses, or a provincial government signals fiscal stress, or a major manufacturer declares bankruptcy. And suddenly, the narrative shifts, confidence evaporates, and the cascade accelerates. This is the crack that becomes an earthquake. And earthquakes don't announce themselves. They just hit. The seismologists can see the fault lines building pressure. They can measure the stress, but they can't predict the exact moment of rupture. All they can say is, it's coming. And for Canada, it's coming. Here's what the experts gloss over. They focus on official statistics, GDP growth rates, inflation targets, interest rate decisions, but they ignore the human element, the psychological breaking points, the moment when a critical mass of people lose faith in the system. That's when crises accelerate, not because the fundamentals changed overnight, but because perception shifted. And perception is reality in financial markets. So here's your choice, stated plainly. Do you trust the system to hold together? Do you believe Canadian policymakers have tools they haven't used yet, solutions they haven't tried, miracles they can pull from thin air? Or do you trust the math? Do you trust history? Do you trust the observable reality that economies built on debt, demographics, and external dependencies collapse when those supports fail? History favors the prepared, not the optimists. not the pessimists, the prepared, the people who looked at the data, understood the trajectory, and took action before the crowd panicked. In every crisis, there are those who saw it coming and protected themselves, and there are those who were blindsided because they refused to believe it could happen here. Canada is not special. It is not immune. It is subject to the same economic laws as every other nation. And right now, those laws are rendering judgment. The debt is unsustainable. The growth is gone. The exports are collapsing, and the system is breaking. The only question is whether you will act while there is still time, or whether you will wait until the window closes. The window for preparation is closing, not in years, not in months, in weeks. The data is clear, the trajectory is set, and the outcome is inevitable. The only variable is you, what you choose to do with this information, whether you step out of the line of fire or stay in the path of the collapse. Friends, the choice is yours, but choose wisely, because the mathematics of this crisis are unforgiving, and history does not reward those who hesitate.